Hey, PK, it feels like every day there's some new economic headline, doesn't it? And all this talk about potential tariff wars.
Indeed, Anna. It's pretty
It
crazy.
can be pretty unsettling, especially if you're a homeowner or maybe thinking about investing here in Singapore. There's just so much information, so much noise.
Absolutely. It's really easy to get caught up in those immediate headlines, and start thinking about all the negative possibilities. And that's really what we want to dig into today. We're going to take a closer look at how these U.S. tariff discussions might actually affect Singapore's economy and, maybe more to the point for many, the property market. We'll also, explore how the market's handled bumps in the road before and think about what's going on underneath even without all this current uncertainty.
Right. We've sifted through quite a bit to bring you this perspective. The aim really is to pull out the essential insights for you, try to move past the surface worries, maybe offer a more solid understanding of what's happening and what it could mean. Okay, so let's start there. The tariff wars, what's the immediate thought?
Well, the first thing that usually jumps out is the potential for prices to go up.
Yeah,
Right?
inflation concerns.
Exactly. If tariffs mess with supply chains, how goods move around, then yeah, the cost of things can increase. That hits everyone. But it's maybe helpful to compare it. Think back to the COVID pandemic. That was a massive disruption. Widespread shutdowns, businesses grinding to a halt.
Yeah, everything just stopped, felt like it anyway.
Right. Now contrast that with the current tariff talk. Even with all the discussion, for the most part, life goes on. Business continues. People are working. Goods are still moving. The basic engine hasn't stalled in the same way.
Okay, that's a useful distinction.
So it suggests that tariffs alone, while not ideal, might have a less fundamentally disruptive long-term impact than a crisis that literally stops everything.
That makes sense. We're not facing that same kind of like systemic shock. And these trade things, they aren't permanent, are they?
No, not at all. That's a key point. Trade agreements, tariffs, relationships between countries,
Things change.
they're constantly shifting. Things change. Policies get adjusted, reversed even. We've seen it happen before. So this idea of a permanent escalating trade war, well, it's not necessarily the guaranteed outcome. There's a lot of fluidity there.
Okay, so acknowledge the potential price bumps and the uncertainty. Yes, but maybe the scale and nature are different from a full-blown crisis.
Got it. Let's switch gears a bit then. How has the Singapore property market actually reacted during past uncertain times? What can history tell us?
Yeah, looking back is quite revealing. Take Park Riviera, for instance, launched back in 2017. Initial sales were, well, they were slow. Only a small fraction sold right at the start. And, at the time, some people might have looked at that and thought, oh, weak project or the market's cooling off. The usual pessimism.
It's easy to think that, isn't it? Slow sales must mean something's wrong. It is easy to think that. But what happened next is interesting. Pretty quickly, actually, prices for similar units in that same development started to climb quite noticeably. In fact, we saw something kind of similar with Florence residences in 2019. Again, the initial take-up rate wasn't spectacular, raised a few eyebrows.
So another case where that initial reaction wasn't the whole story.
Exactly. And again, over time, Florence residences saw significant price appreciation. So these examples, they teach us something important. Low initial sales don't always signal a bad long-term investment or a weak market overall. Buyer sentiment at launch can be affected by lots of other factors.
That's a really good point. Challenges that immediate reaction. Yeah. So, okay, beyond those specific projects, what are the bigger things that have helped the market here handle uncertainty?
Well, a huge factor has been the cooling measures brought in since 2013. Things like TDSR, the total debt servicing
Right,
ratio.
and the LTV limit?
LTV, loan to value limits. Yeah. And ABSD, the additional buyer's stamp duty. These have fundamentally changed the market landscape. They've made it much more stable, less driven by short-term speculation compared to, say, before 2013.
Yeah, they've definitely made it harder to just jump in and out or get over leveraged.
Precisely. You need more cash up front now. Significant down payments are required, and what that does is build holding power.
Holding power meaning?
Meaning homeowners are better equipped financially to ride out market dips without being forced into selling quickly. When you've got a big chunk of your own money tied up, you're less likely to panic sell during a temporary downturn.
That makes a lot of sense. More skin in the game, basically. So what about something more recent like the COVID period? How did property hold up then?
Well, during 2019-2020, sort of the peak pandemic uncertainty, we did see an average price drop for new launches, but, and this is key, It was relatively small, around 7.1% on average.
Okay, 7%. How does that compare?
If you compare that to the stock market volatility during that same time, the drops there were much, much steeper.
So property showed more resilience compared to stocks during that massive global shock.
It really did. And maybe even more telling is what happened afterwards, the recovery. The property market here bounced back much faster and much higher than the stock market did.
Faster and higher.
Yeah, we saw property prices, in some cases, rebounding by like 50%, while the stock market recovery was maybe closer to 25%.
Wow, that's a huge difference, right? Really highlights that relative stability.
It does. And historically, if you look at Singapore, the typical time people hold property and the time it takes for the market to recover after a dip, it's generally been less than 3 years.
Less than 3 years for recovery.
Historically, yes. Which suggests a pretty quick bounce back ability, generally speaking.
Okay, so strong historical resilience helped by cooling measures. Good holding power, relatively quick recovery times. Let's explore another angle. What if there weren't these tariff war worries right now? No major uncertainty looming. Would buyers just be flooding the market?
That's a great question, because it touches on something important. There's almost always some kind of worry or caution in the market cycle, isn't there?
Yeah, seems like it. If it's not one thing, it's another. Interest rates, regulations, global events.
Exactly. So even without tariffs, other factors are always at play. Actually, if you look back at the first, say, 3 quarters of 2024, demand in the property market was fairly quiet, right? It was slower then. But that wasn't just down to fear. A big part of it was simply fewer new projects being launched, less supply coming online, and also interest rates, while maybe starting to ease a bit, were still seen as relatively high by many potential buyers. That borrowing cost factor was still there.
So limited new choices and the cost of borrowing were key reasons for that slower patch.
Correct. Then what happened in the last quarter of 2024? We saw a definite pickup in sales.
Why the change?
Well, partly because more new projects hit the market, gave buyers more options. And importantly, buyer confidence seemed to lift as interest rates looked like they were stabilizing, even dipping slightly.
So when you get appealing new properties and a slightly better feeling about borrowing costs.
The underlying demand starts to show itself again.
Exactly. And look at early 2025. The sales volume we saw just in those first few months was pretty substantial, comparable to the entire first 9 months of 2024 put together.
It really does suggest there's a solid base of demand waiting, doesn't it? When the conditions feel right.
It strongly suggests that yes, when the right opportunities are there and the financial climate feels a bit more settled, people are ready to move.
Okay, so putting aside the short-term ups and downs, what about the really fundamental long-term drivers for Singapore property? What keeps demand ticking over?
I think the biggest one, undeniably, is population growth. You look at the government's long-term plans like the 2012 white paper, they projected a population of 6.5 to 6.9 million by 2030.
And where are we now?
We're already over 6 million in 2025, so we're tracking along with those projections.
And more people. Well, they need more homes. It's pretty basic. It's fundamental. This basic need for more housing, driven by more people living and working here, creates a really strong, persistent underlying support for property demand in the long run that exists regardless of temporary worries like tariffs.
So you have to look past the immediate headlines, the noise, and see those bigger demographic trends.
Absolutely. And, this ties into the difference between having an investment mindset versus a speculative one.
How do you mean?
Well, an investor tends to look longer term, right? They understand markets move in cycles. They focus on these fundamentals like population growth. A speculator maybe is more focused on quick gains, more likely to react strongly to the day-to-day news and anxieties.
That's a very important distinction, making informed choices based on the bigger picture, not just reacting to fear or hype. Right. Okay, as we start to wrap this up, what are the main things listeners should probably keep in mind from our chat today?
Okay, I think the key takeaways are, first, yes, potential tariff wars add uncertainty. That's real. And second, the Singapore property market has shown remarkable resilience in past crises.
Built on solid foundations.
Built on strong fundamentals, exactly. And bolstered by those cooling measures which have created a more stable, less speculative market with good holding power. Third, there's clear underlying demand, especially visible when conditions align. And fourth, that long-term population growth provides a powerful ongoing support.
So it's really about seeing the bigger context, not just the immediate fear factor.
Precisely. Understanding these deeper dynamics is key, rather than just getting swayed by short-term noise or speculation. It allows for a more strategic and informed approach to any property decision.
And maybe here's a final thought for you listening. How does really grasping these fundamentals, the population trends, the market structure, the historical resilience, how does that actually empower you? Does it help you navigate the inevitable uncertainties? Maybe even spot opportunities instead of just feeling driven by fear or the latest breaking news?
Yes, this year 2025 is going to be an exciting year, especially for the CCR. In fact, in our Property Wealth Partners Masterclass, many of our community members are gearing up for our activities and regular market updates. Reach out to me and I'll be able to point you in the right direction to get connected to our community and our next session. And I look forward to sharing more with you soon.